Ever stared at your investment portfolio, that sensible mix of stocks and bonds, and felt like something's missing? Especially when the headlines are all doom and gloom about market corrections or economic slowdowns. You're doing your best playing by the usual rules, but that truly massive wealth, the kind that seems to laugh in the face of market logic, just feels miles away. Forget what you think you know. We're often told the stock market is the great equalizer, the main road to getting ahead. Yet, when traditional markets take a nosedive, a surprising number of super wealthy folks don't just protect their money, they actually keep growing it, sometimes like crazy. How do they pull that off? They're not just banking on Wall Street, they're playing a whole different game. Recent reports are showing that these high net worth individuals are putting way more cash into assets of typical stocks and bonds. We're talking up to 20%, even 50% of their portfolios in some cases. For ages, the average investor has been nudged down a pretty narrow path: stocks, bonds, mutual funds, maybe a few ETFs thrown in. Now that's not to say these are bad. They're the foundation of many solid financial plans. But relying on these traditional options in today's wild economic climate, it's like bringing a rowboat to a yacht race. Market swings can wipe out years of careful saving. Inflation can quietly nibble away at what your money can actually buy. And those really explosive growth opportunities, they often happen a company even thinks about going public on the stock market. The wealthy get this. They see that public markets, while easy to get into, are also swayed by public opinion, super smart trading algorithms, and that herd mentality that can inflate bubbles and trigger crashes. They understand the limits of sticking only to what's publicly listed and easily bought or sold. The frustration for many is real. You watch your portfolio take a hit during downturns, while you hear whispers about smart money making big, profitable moves somewhere else. This feeling that others have some deeper insight, a secret map to financial strength and growth, is exactly why we're talking today. The secret isn't magic. It's about strategically diversifying into a world most people barely know exists: alternative investments. So, what exactly are these alternative investments that the rich seem to use so well? Basically, an alternative investment is any financial asset that isn't your standard stock, bond, or cash. Think bigger than ticker symbols and quarterly earnings. We're talking about real, tangible things like huge real estate projects or super rare art, and smart financial moves like investing in private companies before they're famous, or using complex fund setups designed to handle tricky market conditions. Why are people with serious money making this deliberate shift? There are a few pretty powerful reasons. First, diversification that actually protects you. The wealthy aren't just spreading their cash across different stocks, they want assets that act differently from the public markets. Many alternative investments don't move in lockstep with traditional stocks and bonds. This means when the stock market zigs, these assets might zag, or at least stay steady. That gives a strong buffer against big swings and lowers overall portfolio risk. Second, the chance for much bigger returns. While public markets can grow your money, some of the most serious wealth building happens privately. Getting in on a promising startup before it goes public, or investing in a massive infrastructure project, can bring returns that blow typical market gains out of the water, especially when public stocks might already be expensive or all lumped into a few big names. Third, a shield against economic troublemakers like inflation. Physical assets like real estate and commodities often act as a great defense when prices are rising. As everyday costs go up, the value of these tangible assets tends to climb too, keeping your purchasing power intact or even growing it when cash and bonds might be losing value. And finally, access to unique, often exclusive opportunities. The world of alternative investments opens doors to markets and deals that the average investor just can't get to through their regular brokerage account. This exclusivity, plus the potential for higher returns, is a key part of how savvy investors build and hang on to their fortunes. It's about stepping out of the crowded public square into less traveled, but potentially much more rewarding financial territories. Current trends for 2025 show this move into alternatives by the wealthy isn't just continuing, it's speeding up, driven by a need to protect wealth in uncertain times and find growth in new, innovative areas. Alright, let's pull back the curtain a bit more and see what kinds of alternative investments are popular with folks building serious wealth. This isn't everything, but it covers the main players. Private equity, this is a huge one. It means investing directly in private companies not listed on public stock exchanges. The big draw? Getting in on the ground floor of the next big thing. Imagine someone who invested a modest sum in an unknown tech startup in its early days, only to see that company become a global giant, multiplying their initial stake 1,000 times over. That's the dream these investors chase before everyone else knows about it and its value skyrockets. Wealthy investors and institutions often look to private equity for returns that have historically beaten public markets, with a particular focus in 2025 on cutting-edge industries like AI, biotech, and renewable energy. Real estate. We're not just talking about owning a home. The wealthy invest strategically in all sorts of property. Think of someone who saw potential in a neglected urban area, bought a rundown commercial building, redeveloped it into a vibrant mixed-use space, and now reaps benefits from high rental yields and massively appreciated property value. They might invest in commercial buildings, big residential developments, and specialized stuff like data centers. They also use real estate investment trusts, or REITs. Real estate offers potential rental income, value growth, and some nice tax breaks. In 2025, there's a lot of buzz around sectors like data centers and logistics hubs. Hedge funds. These are investment pools managed by pros who use a variety of often complex strategies. Picture an investor whose hedge fund manager, through astute analysis of global economic trends, made tactical bets that paid off handsomely even when traditional markets were chaotic, delivering strong positive returns. They might bet on stocks going up and down, invest based on big economic trends, or try to profit from tiny price differences. The main aim is often to get positive returns no matter what the overall market is doing. For 2025, hedge funds are considered important for navigating policy changes and market turbulence. Commodities. This means investing in raw materials. Think gold, oil, timber, or crops. Consider someone who, anticipating rising inflation, strategically bought gold. As the cost of living climbed, so did the price of gold, effectively shielding their wealth from erosion, and even growing it. Commodities, especially precious metals, are often seen as a store of value and protection against economic uncertainty. Private debt or credit. This is about lending money directly to companies. Imagine an entrepreneur whose promising mid-sized company couldn't get a traditional bank loan for expansion. A private credit fund stepped in, provided the capital, and as the company grew and repaid the loan with healthy interest, the fund's investors earned attractive returns, far outstripping standard bond yields. This can include direct lending or investing in the debt of struggling companies, and it's a rapidly growing area with significant expansion projected through 2025. Infrastructure. Investing in essential physical systems like toll roads, airports, or renewable energy projects. Think of investors who financed a large-scale wind farm. They now benefit from long-term contracts selling energy, providing steady inflation-linked income, all while their investment in a critical asset appreciates. For 2025, there's special interest in infrastructure for renewable energy, smart cities, and data centers. Collectibles and tangible assets cover things like fine art, rare coins, or vintage cars. Imagine an astute collector who purchased a piece of art from an unknown artist. Years later, the artist becomes world-renowned, and that once modest purchase sells for a fortune at auction. While sometimes seen as more speculative, these assets can appreciate significantly due to rarity and demand, often moving independently of financial markets. Cryptocurrencies are digital currencies like Bitcoin and Ethereum. Picture an early adopter who, understanding the transformative potential of blockchain, invested a small amount in a nascent cryptocurrency. As that currency gained mainstream acceptance, their initial gamble turned into a significant fortune. They're volatile, but some wealthy investors allocate a small portion here, seeing them as a high-risk, high-reward bet on future financial tech. Understanding this wider range of tools is the first step to figuring out how the wealthy build portfolios that are both tough and geared for growth. It's about having more options, more ways to succeed. So why do sophisticated investors put so much money and effort into the often complicated world of alternative investments? The upsides are pretty tempting, and directly tackle the weak spots of sticking only to traditional methods. True portfolio diversification. This is probably the benefit you hear about most. As we've said, alternatives often move to their own beat, separate from the stock and bond markets. Because they don't always follow the crowd, during times when public markets are stressed, these assets might hold their value or even go up, cushioning your overall portfolio and reducing that awful stomach-lurching volatility. It's about building a financial ark, not just a speedboat. Enhanced potential for higher returns, also known as alpha generation. Many alternatives, especially in private equity venture capital and certain hedge fund strategies, offer the chance for much higher returns than you'd typically find in mainstream markets. This extra return is often called alpha profit, made above and beyond what the general market gives you. By getting into companies before they IPO or joining specialized credit deals, investors can tap into growth phases the public often misses. When inflation is high and the buying power of your cash is shrinking, tangible assets and certain alternatives really shine. Real estate, commodities like gold and oil and infrastructure projects tend to see their values rise along with the general cost of living. This helps protect and even grow your real wealth, making sure your money tomorrow is worth as much as, or more than, it is today. The world of alternatives is huge and varied, offering ways to invest in markets, strategies, and assets that you just can't find through a standard brokerage account. This could be investing in a cutting-edge biotech firm, a green energy project, or a bargain real estate opportunity. This access gives them an edge. Certain alternatives like rental properties, infrastructure investments, and private credit can bring in steady, predictable income. This is especially appealing when interest rates are low and traditional bonds might not be paying much. While some alternatives are all about high growth, others are designed primarily to protect your initial investment, especially when the economy feels shaky. Some strategies used by hedge funds, for instance, are specifically built to shield capital during market downturns. The attraction isn't just about chasing unusual investments, it's about strategically using a wider set of tools to hit financial goals that might be out of reach with conventional methods alone. It's about building a portfolio that's not just strong but also flexible and ready to seize opportunities. Okay, before you rush off to empty your 401k and start bidding on rare paintings, you absolutely need to know that the world of alternative investments, while it can be very profitable, also comes with some serious risks and complexities. The wealthy play in this space, but they usually do it with expert advice and a very clear picture of the potential downsides. Illiquidity. This is a big one. Unlike stocks you can sell with a click, many alternative investments are hard to cash out quickly. Selling a property, getting your money out of a private equity fund, or finding a buyer for a rare collectible can take time, sometimes months or even years. This means your money can be tied up for a long while, so it can't be cash you might need in a pinch. Complexity and due diligence. These aren't simple buy and hold deals. Figuring out the details of a private equity investment, the strategy of a hedge fund, or how much a unique collectible is really worth takes specialized know-how and a lot of homework. The information available might not be as clear or standardized as it is for publicly traded companies. Higher fees. Alternative investments often have heftier fee structures. Hedge funds, for instance, are known for the 2 and 20 model, typically a 2% management fee on your assets and 20% of any profits. Private equity funds also have significant management and performance fees. These can really take a bite out of your returns if the investment doesn't do as well as hoped. Limited regulation and transparency. Many alternative investments operate with fewer rules and less oversight than public markets. This can ramp up the risk of fraud or bad management if you're not dealing with reputable people. Transparency can also be a problem, with less public information about what's really going on with the assets or their performance. That said, there's a growing push from big investors for more openness. Higher minimum investments and accreditation. Just getting in the door can be tough. Many of the most appealing alternative investments like hedge funds and direct private equity deals are usually only open to accredited investors, people who meet certain high income or net worth levels, or big institutional investors. The minimum amount you need to invest can be pretty substantial, though options for everyday investors are slowly starting to open up. market risk and volatility still applies. While alternatives can help spread out risk, they're not magically immune to market slumps or just plain bad performance. A real estate project can go belly up, a startup can fail, and even commodities can have wild price swings. No investment is totally risk-free. Valuation challenges. Figuring out the fair market value of unique, illiquid assets can be tricky and pretty subjective. Unlike stocks that have constantly updated prices, putting a price tag on a private company or a piece of art can be more of an art than a science. The secrets of the wealthy aren't just about they buy, but they go about it carefully with expert advice and a full grasp of these potential traps. It's about making calculated risks, not taking blind leaps of faith. After looking at the shiny potential and the serious risks, the big question is, are alternative investments something you should think about? There's no easy yes or no. It really depends on your personal financial picture, your goals, and how comfortable you are with the unique nature of these assets. Generally, alternative investments are a better fit for investors who have a higher risk tolerance. Given that some alternatives can be illiquid, complex, and sometimes more volatile, you need to be okay with the idea of possibly losing some, or in certain cases all the money you put into a specific deal. If market ups and downs keep you up at night, you'll want to tread carefully here. Possess a long-term investment horizon. Many alternatives aren't get-rich-quick schemes. Private equity funds, for instance, often have lock-up periods of 5, 7, or even 10+ years. You need to be able to tie up your money for the long haul without needing to grab it early. Are seeking diversification beyond traditional assets. If your portfolio is already pretty solid with stocks and bonds and you're looking for ways to really diversify and get returns that don't just follow the main market, alternatives could be a smart next step. High net worth investors often put 15 to 25% or even more into alternatives. Can accept lower liquidity. Like we've really stressed, if you need to be able to turn your investments into cash quickly, many alternatives just won't work. You must have enough liquid cash elsewhere to cover short-term needs and emergencies. Are willing and able to conduct thorough due diligence or hire experts who can. This is super important. Investing in alternatives means committing to a lot of research to understand what you're getting into. If you don't have the time or the know-how, you'll need to work with trusted financial advisors who specialize in this stuff. Many wealthy folks rely on teams of experts. Understand the fee structures. Get clear on how the managers get paid and how those fees will affect your actual returns. And keep in mind, things are always changing. Financial innovation is slowly making some types of alternative investments easier for more people to access through things like crowdfunding platforms, specialized ETFs, and interval funds. But easier access doesn't mean you can skip the caution and understanding. The idea of rich people's secrets should be balanced with a realistic look at your own financial situation and how much risk you're truly comfortable with. Feeling interested, maybe a little bit swamped by it all? That's totally normal. The world of alternative investments is big and can seem complicated. If this chat has got you thinking about how these strategies could potentially fit into your long-term financial plan, the most important first step is education. Do your own research. Learn more about the specific types of alternative investments that grabbed your attention. There are tons of resources online, books and courses out there. Consult with a qualified financial advisor. Seriously, this is key. Find an advisor who has real experience and expertise in alternative investments and who is a fiduciary, meaning they legally have to act in your best interest. Talk about your financial goals, your risk tolerance, and whether these kinds of assets make sense for you. Start small and diversify. If you do decide to dip your toes into alternatives, think about starting with smaller amounts and spreading your money across different types, just like you would with traditional investments. What are your thoughts? Have you tried alternative investments? What was your experience, or what questions do you still have? Share your insights in the comments below. Let's learn from each other. And of course, if you found this information useful and want to learn more about sophisticated investment strategies, make sure to like this video, subscribe to our channel, and hit that notification bell so you don't miss our future content. The secrets of how the wealthy build and protect their money aren't really secrets at all. They're well-known strategies that are all about looking beyond the usual options. They get that real financial strength and big growth often come from the world of alternative investments. Things like private equity, real estate, hedge funds, and more. These options offer the potential for better diversification, higher returns, and a good defense against inflation. But they also come with bigger risks, more complexity, and less liquidity. The main takeaway isn't to just blindly copy what others are doing. It's to understand the ideas behind it, strategic diversification, thinking long-term, and having the courage to explore opportunities off the beaten path, backed by solid research and often expert help. Unlocking your own version of an investment fortune means expanding your financial toolkit and making smart decisions that fit your unique situation. The question isn't just how the wealthy invest, it's how you can thoughtfully and strategically build a stronger financial future.